Welcome to our ISA Outlook 2024. My colleague Eduardo and I will be sharing LaSalle's key themes that tie together global markets and shape our outlook for the coming year. The macro context for real estate remains unsettled as we continue to search for peak interest rates. Earlier in 2023, rates exhibited high volatility, but little overall trend. They moved mostly sideways or only gradually upward. This was enabled by cooling inflation and expectations that central banks were reaching the end of their tightening cycles. But more recently, there has been a renewed surge in interest rates in several key markets. Corporate bond yields, which we use as a building block for our pricing models, have taken a clear turn upwards, reaching or surpassing levels last seen in late 2022. The recent upward trend in rates may prove short-lived, but history suggests that whenever there's a big increase in interest rates, there's an increased risk that something breaks, whether that be a financial institution, a part of the capital markets, or the like. Also, extended periods of yield curve inversion, as we have seen in 2023, tend to presage economic downturns. Both factors should raise the alert level for the global economy in 2024. That said, real-time evidence does not point to an imminent global recession, especially given the strength of the US economy. Labor markets have been surprisingly resilient, and forecasts of economic growth in key economies have mostly been revised upward for 2023, as a potential slowdown is pushed into 2024. Fortunately, inflation is already cooling across advanced economies, especially in the US, Canada, and the Eurozone. But inflation's moderating slowly and remains meaningfully above central bank targets. It is still far from clear that a so-called soft landing can be achieved. At LaSalle, we aim to be macro-aware, but we are not macroeconomists. Our recommendation is largely to be a taker of bond market signals, reflecting them in valuation models, but focusing on insight within real estate to find the best relative value. That is the focus of the remainder of the ISA Outlook 2024.
On the real estate capital markets front, the math of higher rates underlies the repricing of real estate that we have seen, and we believe that this gives rise to both challenges and opportunities. If we first focus on the challenges, equity flows have fallen back sharply. Now, why is this? The flow-through of higher rates hits would-be buyers first as they borrow at today's cost of debt. Sellers, on the other hand, are much slower to catch up. They might have fixed debt arrangements with medium to long-term duration that may lead them to wait and hope that they will be able to fetch a selling price closer to their book value at some point in the future. But until these values converge, the consequence is that a standoff remains between buyers and sellers, with an obvious bid-ask spread between them. Now, this has manifested itself in the data through a notable slowdown in transactions activity in the first half of 2023. This chart here shows real estate investment volumes by region, and it highlights that transactions are down by close to 60% in the Americas, 55% in Europe, and a little less drastically in Asia Pacific at minus 24%. The dramatic pullback in activity points to the sizable gap between those buyers and those sellers. One reason to think that transaction activity will pick back up is the sheer volume of capital waiting on the sidelines. Measures of dry powder available for real estate investment strategies remains elevated. For example, Preqin tracks and estimates that over $400 billion are earmarked for real estate investments, down only 10% on the figure from the end of 2022. But there are good reasons to think that this volume of dry powder might be less effective than it could have otherwise been. And these are also related to the math of higher interest rates. Higher rates manifest themselves in real estate markets as real estate debt has become costlier and less available. In part, this reflects the fact that 2023 was a tough year for banks, with the notable failures of Silicon Valley Bank, Signature Bank, First Republic, all in the US, and the merger of Credit Suisse and UBS. Since then, the perception of bank failure risk as priced by CDS markets has fallen. And now, with all of that said, bank lenders are only one slice of the real estate debt pie. This chart here highlights the makeup of real estate lenders in a few major markets around the world. Banks account for roughly 40% of lending to income-producing real estate in the US, and the same figure in the UK stands higher at about 54%. And it is closer to 80% or higher in the EEA or Australia. Now, the implication here is that a bout of renewed stress in the banking sector could create risks to the orderly flow of capital to the real estate sector. But this is likely to also provide interesting opportunities to private lenders.
Turning to property market fundamentals, we still observe solid occupational conditions in many key market segments. We are also seeing a real cooling in sectors that have been riding high, especially logistics, rental housing, and life sciences real estate. These recently hot sectors are coming off the boil. For example, logistics rent growth shows a marked slowing from peak levels across the globe, but remains very strong compared to history. Aggregate data show this cooling has happened across North America, Europe, and Asia Pacific, though there are exceptions at the country and market level. Part of that cooling trend is just down to the macroeconomy, it's slowing. But it's also due to ripple effects originating from the pandemic shock. COVID lockdowns triggered waves of disruption, adjustment, and eventually normalization. This has happened to both demand and supply. On the demand side, logistics is case in point. The sudden shift of retail demand to online in the pandemic drove a frenzy of logistics leasing that went a little too far. And we see pullback in demand today. We've seen similar demand normalization in other sectors such as rental housing, resort hotels, and life sciences. On the supply side, there's clearly post-pandemic lumpiness. Key sectors, especially logistics and apartments, are seeing temporary spikes in deliveries in many markets. Pipeline delays due to lockdowns and supply chain issues are one part of the supply spike story. So is cheap development finance and low exit yield assumptions in 2021, which enabled more development projects to pencil as profitable. But the pattern of cooling absolute growth in the strongest market segments does not really alter the relativities between sectors. Our most favored sectors are still well positioned on a relative basis, which you can see in this chart. One way to assess the tightness of a market is to compare current vacancy, shown here for various global market segments on the x-axis, and long-term average vacancy, shown on the y-axis. Markets with tighter vacancy than normal tend to see growing rents. So if we break these down by sector, we see that logistics markets are the tightest. Living and residential market segments are broadly balanced, while offices show a really wide dispersion, with the loosest office markets being those in the US. So while our favored sectors of logistics and residential remain strong, their hot fundamentals cooling are a reminder that trees do not grow to the sky. Predicting that frothy growth around peaks will continue forever can be a recipe for overpaying.
When reading descriptions of the current state of market fundamentals, the word bifurcation seems to appear more and more often. In last year's ISA Outlook, we pushed investors to look beyond the sector chasm and consider widening gaps within sectors. However, in this year's ISA Outlook, we invite investors to look beyond the word bifurcation for a number of reasons. The first being that bifurcation implies that outcomes either stand at one side of a divide or another. In reality, the dispersion of outcomes or real estate market conditions exists on a wide spectrum with a very wide array of possibilities. We currently are monitoring several key divides in asset performance. Sustainability credentials like green certifications and buildings' alignment with net zero carbon pathways can be a major differentiator for assets. In our recently published ISA Focus report on the value of green, we assessed the large number of empirical studies estimating the impact of green features on rents and values compared to those that lack them. Similar results are also evident in data that we monitor. Now, this chart here highlights data from MSCI dissecting the sales price gap between office buildings with and without sustainability ratings, both in Paris and in London. The chart highlights that there is both a meaningful and increasing price gap between buildings with such credentials and those that lack them. Now, another key divide is particularly obvious for office and retail assets. Asset-level experiential factors seem to be underlying a gap between successful properties and those that are more challenged. This divide has arisen due to the improvements we have seen in either shopping online or collaborating online that have been evident over the last few years. So what do these compelling retail environments look like? The types of retail formats that have tended to outperform have 1, larger shares of F&B occupiers, or 2, a curated offering of niche, local, or otherwise unique brands and experiences. Now, experientially compelling offices are a little more recent, but the idea is that successful offices have features that make bearing the cost of commuting, either in terms of financial cost, time, and discomfort, worthwhile. The differentiators here include a wide range of flexible working areas, wellness features, and a vibrant and socially focused amenities. How bifurcation should inform investment strategy hinges on how this dispersion is priced. Is the winning side of a bifurcated sector strong enough and priced appropriately to generate a suitable risk-adjusted return? How do the best segments of a challenged sector compare to the range of other investment alternatives? Is the gap between winning and losing assets bridgeable through refurbishment and repositioning? And if so, does bridging that gap generate an appropriate risk-adjusted return? So in short, there are always winning and losing assets. What we have to think about, though, is what the NOI profile is like relative to how it is priced.
Our investment recommendations have changed only subtly since last year's ISA outlook. We remain drawn to the long-term growth potential of logistics and residential and their various adjacent subsectors. Office and retail assets are by no means uninvestable, but their prospects are highly variable by market and subtype, and they're vulnerable to divides by factors like property quality. We continue to advocate for investing in the most dynamically repriced segments of the market, such as listed equity and debt, and in structured investments with debt-like structures that allow the bridging of bid-ask spreads. And we remain cautious on office markets in North America and commodity office in Europe. We recommend patient and flexible deployment of capital, given that situational opportunities may arise from dislocation within capital stacks. However, over-caution can come at the cost of missed opportunities. Prospects for interest rates, economic growth, and real estate fundamentals are all uncertain, but history has shown that the best vintages tend to be those immediately following periods of disruption. More detailed, granular discussion of investment opportunities at the regional level is forthcoming in ISA Outlook 2024 chapters on Europe, North America, and Asia Pacific. We hope you continue to watch and read.